Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in financial reports, and today we have Comerica Incorporated's latest quarterly filing that might just be as dramatic as a season finale cliffhanger. Get ready because we're diving deep into their financial condition and results of operations for the period ending the 30th of September 2025. And make sure you stick around because we've got some big news about a potential merger that could change everything. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these filings even further. Alright, let's start by looking at their balance sheet at the 30th of September 2025. Total assets were $77.4 billion. That is a slight decrease from $79.3 billion at the end of 2024. This dip was mainly due to a drop in interest-bearing deposits with banks, essentially less money parked at the Federal Reserve and other banks. But hey, here is the interesting part. Their total loans actually saw a small increase, growing by $347 million. This growth was fueled by areas like environmental services and wealth management, while national dealer services saw a dip. Now, on the other side of the coin, total liabilities went down too by about $2.8 billion. This was largely because of fewer non-interest-bearing deposits and less medium and long-term debt. Meanwhile, shareholders' equity jumped up by a healthy $886 million. This boost largely reflects a reduction in their accumulated unrealized losses on investment securities and cash flow hedges, and of course the net income they earned during the period. It shows they are rebuilding their equity cushion, which is always a good sign. Shifting gears to their income statement for the quarter ending the 30th of September 2025, net income was $176 million. That's down from $199 million in the previous quarter. The main culprits here were higher non-interest expenses and a dip in non-interest income. On the flip side, they did see a decrease in the money set aside for potential credit losses, which helped cushion the blow a bit. Let's talk about their net interest income. For the 3 months ending the 30th of September 2025, it was $574 million. That is almost the same as the $575 million in the previous quarter. However, their net interest margin, which is a key measure of profitability for banks, actually decreased by 7 basis points to 3.09%. This squeeze is happening because they had a significant jump in interest-bearing deposits and had to pay more interest on them. While they managed to reduce their short-term and long-term debt costs, the cost of deposits is eating into their profits a bit. The provision for credit losses, that is the money a bank sets aside for potential bad loans, was $22 million for the quarter. This is a good sign because it is down from $44 million in the prior quarter. Their total allowance for credit losses also dipped slightly to $725 million. This suggests they see the economy as stable enough not to expect a huge wave of loan defaults right now. That said, net loan charge-offs, that is the loans they actually wrote off minus any recoveries, increased to $32 million. So while they are not setting aside as much money, they did have to write off a bit more in actual bad loans. Non-interest income, which is income from things other than loans and deposits like fees and commissions, dropped to $264 million from $274 million. Fiduciary income and capital markets income were down. Think of fiduciary income as fees from managing trusts and estates, and capital markets income from services like helping businesses raise money. These are often sensitive to market conditions. On a brighter note, bank-owned life insurance income saw a seasonal bump, and other non-interest income stayed about the same. Now for non-interest expenses, these went up by $28 million to $589 million. A big chunk of this increase came from what they call other non-interest expenses, which included higher litigation-related expenses, operational losses, and consulting fees. Salaries and benefits also saw a slight decrease due to incentive compensation adjustments, but overall expenses are ticking up, putting pressure on their bottom line. Let's zoom out and look at the first 9 months of 2025 compared to the same period in 2024. Net income actually rose to $547 million from $528 million. This was largely driven by better net interest income, meaning they made more on the difference between what they earn on loans and what they pay on deposits. However, they also had to set aside more money for credit losses, and non-interest expenses went up too. Their net interest income for these 9 months jumped $109 million to $1.7 billion. This is a pretty significant improvement. Part of this is due to lower prevailing interest rates, which means they paid less on their borrowings. They also managed to reduce their reliance on more expensive funding like brokered deposits and advances from the Federal Home Loan Bank. But here is where we see another crack. The provision for credit losses shot up by $58 million to $86 million for the 9-month period. This suggests that despite the overall increase in net interest income, concerns about the economy are growing, leading them to increase the buffer for potential loan defaults. Net loan charge-offs also surged by $50 million. Non-interest income saw a small dip of $12 million. This was mainly due to lower card fees, particularly from government interchange fees, which can be a significant revenue stream. Non-interest expenses ticked up slightly by $14 million, higher salaries and benefits, partly due to annual raises and some staff additions, along with increases in software costs were the primary drivers. They did manage to reduce FDIC insurance expenses, likely because their deposit-based composition changed. Now, this filing breaks down their business into segments. First, the commercial bank. For the first 9 months of 2025, this segment saw its net income drop by 13%. Net interest income decreased because of lower income from loans, but they also had a big jump in the provision for credit losses and higher net charge-offs. It seems like their core commercial lending business is facing headwinds. Next, the retail bank. This segment actually showed strong growth with net income soaring by 89%. Net interest income was up significantly, thanks to more favorable interest expense and deposit pricing. Non-interest expenses also decreased, likely due to lower FDIC insurance fees. This segment is clearly performing well, which is a bright spot. Then we have wealth management. This segment remained pretty stable, with net income showing a modest 3% increase. Net interest income saw a small rise, and non-interest income was flat. Non-interest expenses did go up a bit, mostly due to higher litigation costs. Finally, the finance and other category, which includes their investment portfolio and other corporate activities. This segment operates at a loss, which is typical for such treasury functions. For the 9 months of 2025, the net loss narrowed a bit. Average deposits here, which are mainly brokered deposits, really dropped, which likely helped reduce the overall interest expense. Looking at the big picture of their financial condition, total assets at the end of September 2025 were $77.4 billion, down from $79.3 billion at the end of 2024. This was mainly due to less money parked at the Fed, but as we saw, loans did grow a bit. Something to keep an eye on is their deposit base. At the 30th of September 2025, uninsured deposits made up 56% of their total deposits. That is an increase from 52% at the end of 2024. While they say these deposits are well diversified, a high percentage of uninsured deposits can be a vulnerability in times of financial stress, as we saw in past bank runs. But here is the bombshell news, a merger. On the 6th of October 2025, COMERICA Incorporated announced it is merging with Fifth Third Bancorp in an all-stock deal. If this goes through, COMERICA shareholders will get 1.8663 shares of Fifth Third stock for each COMERICA share. Fifth Third shareholders will own about 73% of the combined company and COMERICA shareholders around 27%. This is a huge deal and it is expected to wrap up by the end of the first quarter of 2026, pending approvals. This merger could really reshape the competitive landscape. Let's briefly touch on their capital. Their estimated Common Equity Tier 1 capital ratio, a key measure of a bank's financial strength, was a solid 11.90% at the 30th of September 2025. This is above the regulatory minimums and has remained pretty stable. It is good to see they are maintaining a strong capital position, especially heading into a merger. Now, no merger is without its risks, and this report highlights them. The biggest concern is that the conditions for the merger might not be met, including getting all the necessary approvals from shareholders and regulators. There is also the risk of integration challenges, meaning combining two large companies always comes with unexpected costs and difficulties. They are also going to experience business uncertainties while the merger is pending and employee retention could become a challenge. So, what does all this mean? COMERICA's core lending business seems to be facing some pressure, with higher loan losses and provisions. However, their retail banking segment is performing exceptionally well. And the upcoming merger with Fifth Third Bancorp is a major strategic move that could redefine their future. The success of this merger will hinge on navigating regulatory hurdles and successfully integrating two large organizations. While their capital position looks strong, watch out for those rising uninsured deposits and the complexities of integrating a business of this scale. What is your take on COMERICA's latest numbers and this massive merger? Are you excited about this combination or concerned about the risks? Drop your thoughts in the comments below. If this deep dive was valuable, hitting that like button really helps us out, and subscribe for more corporate breakdowns. Don't forget to check out our Discord community in the description. Thanks for watching. See you next time.